Hey, have you ever wanted to build a portfolio from scratch? If so, stick around because today that's what we're going over on Research and Design. Hey everyone, welcome back to the channel. Today we're going to be going over investing for beginners, how to create a portfolio and build wealth for your family and future generations. I know this can seem like a daunting task. I remember as a child when my family first introduced me into investing, I figured you needed to have an advanced degree. I figured there was no way a common person could possibly understand how to invest and how to get started in the market, whether that's stocks, ETFs, bonds, real estate, and today crypto, NFTs, etc. But today we're going to go through all that. We're going to go through the what, why, how, and as bonus, you're going to see part of my portfolio. So let's get into it. So on the agenda today, we've got why is investing important? If you've never done it before, what should you consider? What are some of the best places, apps, etc., to invest for beginners? And like I said, bonus, what's in my portfolio? So why is investing important? It's probably pretty easy to surmise why investing is important. But a couple things here: creating wealth for your family, yourself, insulate yourself from a market downturn. Hint, we are in a recession. I mentioned this in several of my other videos, but we are in a recession now, heading into probably when the numbers come out, Q3 of 2022, will again show negative GDP. So you need to figure out a way to not only insulate yourself from a market downturn, like you've seen in the stock market and real estate, but also to hedge against number 3 here, inflation, rising goods, services costs. Number 4, benefit from multiple revenue streams, whether that's passive income through dividends or things like that. Tax coordination and tax deferral. I'll touch a little bit on tax loss harvesting. I think that's very important today. I think a lot of people don't understand the tax benefits and the implications that come from a potential market downturn, and how to offset some of those negatives in your portfolio when it comes tax time. And then the last one, how to teach the next generation about wealth building habits to extend generational wealth. My family started me at a very young age, and my background has been in stocks, equities, bonds, and in the last 5 or so years, real estate. So being able to pass that knowledge along to not only your family, future generations, but also friends, colleagues, etc. So if you've never done it before, and you're brand new and you say, hey, I've got all this money, potentially sitting in a checking account, what should I do with it? Where do I go? Well, first of all, it's good that you're taking the first step. You're asking yourself why. What are you doing? What are you trying to achieve? The second one is, what's your goal and your time horizon? Obviously, someone who's brand new to investing, 18 has a much longer time horizon than someone who's 70 or 80 and who's in retirement. But potentially some people's goals are to have residual income every month, and others' goals is to build generational wealth. And then there's some that want a mixture of both. The good news is there are many investment options that will help you do that. How much risk can you tolerate? So questions like, when there's a market downturn, are you the type of person that will go and sell everything? Are you the type of person that would want to continue to buy even when prices are low? Hint, fire sale, great time to buy. And then how much diversification do you need or want? So are you okay with, and I'm not recommending this, but are you okay with putting all of your money into a single stock like a Tesla or a Microsoft or a Procter & Gamble or an IBM? Maybe you are. Maybe that's something you're okay with. You believe in the core mission of the company, and you're willing to invest heavily into that. So as a beginner, some of the best places to invest could be right at your company. So if your company offers a 401k or an employer retirement plan, they'll typically allow you to put in pre-tax dollars into your 401k. What does that mean? So if you invest $15,000 a year in your 401k, that means at the end of the year, you're able to deduct $15,000 off your taxable income. So if your gross, or the total amount of money you brought in, was $100,000 a year, you would take off the $15,000, and then you're left with $85,000 that you report as taxable income. There's also other retirement plans such as a Roth IRA or a regular IRA. The second one for an individual taxable account outside of your employer would be something like a Betterment, a Wealthfront, or a SoFi. I do use Betterment. I've used Wealthfront and I've used SoFi. For those that are brand new to investing, being able to dollar cost average, or DCA, you'll see that term come up several times, is a great option. It's more of a set it and forget it. You're not paying that 1% carrying fee to a individual to manage your money. And that's great from a expense ratio perspective. And then in things like Betterment and Wealthfront, you're also getting, the tax coordination and the tax loss harvesting. The third one, the target date mutual fund, that's something you would have in your 401k or potentially in an IRA as a mutual fund. And what that means is if you plan to retire in 30 years from now, you would choose a 2052 target date fund that would gradually over time move you out of heavy stocks and more into bonds. So today, say you could be 80% stock and 20% bonds. As time goes on, you would move into a more bond favored investment strategy and less stocks, because traditionally bonds are less risky, although their yield is much lower. Index funds, those are just a mixture of stocks and bonds that trade. They're traded at the end of every day, used in retirement plans. So you'll see a lot of index funds that have a mixture of, say, 500 different stocks and bonds. It's great for diversification. The next one, exchange traded funds. Those are much like index funds, but they are traded several times a day. So think of a normal stock, right? You've got a normal stock and you want to, buy at the open at 9:30 Eastern when the stock market opens. You're able to do that. And then you're able to trade it again and again and again throughout the day. That's typically in the last, say, 10, 20 years, exchange traded funds or ETFs have really taken over the market. And some of the ways to invest into all those is through different apps like Robinhood, Webull, TD Ameritrade, M1 Finance, Acorns. I have used all of these apps. I'm going to link actually the description. I'm going to put links in the description below for my affiliate link to M1 Finance, TD Ameritrade, and Robinhood. Full disclosure, I'm not being paid to sponsor any of these. These are just apps that I've used in the past. So the last thing we're going to go over here is, what does my portfolio look like in 2022? So if you look here on the right, you'll see an entire breakdown, and you'll see about half of it is in stocks, bonds, and ETFs. About 30% is in real estate, about 10% is in crypto, and the other 10% is in venture capital. I did go over a venture capital fund through ARK Invest last week. So check my page under the venture capital playlist if you want to see a complete breakdown of the ARK Invest portfolio for venture capital. But let me get back to this. So from a stocks, bonds, and ETFs perspective, most of my investment is between Betterment and TD Ameritrade. So I use Betterment with an automatic withdrawal every 2 weeks. That's put into a 90-10 portfolio, meaning 90% stock, 10% bonds. I use TD Ameritrade for my individual stocks. So the Teslas, the Microsofts, the Palantirs, et cetera. I buy individual names there. As Betterment does not allow you to purchase individual names. Betterment does have TLH, or tax loss harvesting, and that helps to offset losses, which we've had a ton of in 2022. And you're able to take that loss and offset it in your tax strategy for the year 2022. So what does that mean? So basically what that means is you're able to write off or take a loss on a certain amount of money each year in your portfolio. So in this case, about $3,000 I'll be able to write off as a loss, because I have lost more than 3% this year in the stock market. So through tax loss harvesting, I'm able to offset some of my losses as a more efficient tax strategy. So real estate, I use Fundrise, I do use Landa, and I do use Here. Fundrise is great. They're one of the originals into real estate investing. They purchase things like commercial, single-family rentals, single-family homes, warehouses, etc., all throughout the Sun Belt and the Northeast. Landa is an app that I reviewed on my channel. You'll see it from from last week. Landa gives you the ability to purchase fractional shares of single-family homes throughout the Atlanta and the New York area. And finally, Here is a new venture started last year, I believe. I originally started investing in Here earlier this summer of 2022. Here is a very interesting model. And I'm going to do a breakdown. I'm going to go through a whole breakdown of the Here.com app and company. But in a nutshell, Here allows you to invest fractionally in Airbnb rentals, receive asset appreciation on capital, dividends every quarter if there are any, without doing any really of the legwork. It's more of a set it and forget it. So I think it's really going to take off next year when you start to see, the economy return to normal at the end of 23, early 24. But I was very, very excited to get that into my portfolio. Next, crypto. So I use Ledger and FTX. Pretty simple. Buy all my crypto on FTX. I send it over to Ledger to get the private keys off the blockchain. And then venture capital. I am going to be using the Titan Fund. I'm going to be depositing some money in that sometime in Q4. And again, I do have a breakdown of the Titan Venture Capital Fund on my channel. So take a look at that. At the bottom here, I will say over the last 10 years, I used to be more of an active investor, trading stocks daily or weekly, etc. Trying to scalp, do some short sales, things like that. As times went on, I became more of a passive investor, putting money into things like robos, putting money into things like a Fundrise. It's more of a robo for real estate. And letting the algorithms and letting those things, do what they need to do without me having to manage them day to day. So finally, here's some things to remember. If you're a long-term investor, market swings like the one we're in, as well as in 2000, 2008, 2020, they're all normal. I can't tell how many people, panic sell, and then in 6 months later, when the market's recovered, they're kicking themselves. So if you're a long-term investor, 10 plus years, 20 plus years, just keep buying and dollar cost average every 2 weeks, every month, every quarter, every year. That'll get your average cost down, and your returns over a multi-decade time frame are roughly 7, 8, 9%. Stick to the basics. Don't chase the next high flying stock or coin. I get a lot of people reaching out to me. What do you think about this coin? Would you invest here? Unless you have extra money laying around that you're okay losing, stick to the basics. You'll see some people get lucky on a few coins or a few stocks every now and then, but by far what I've seen over the last 20 years is consistency and sticking to the basics. Don't look at the news and the market every day or every week. This just drives up your blood pressure, especially, something like this year where we've seen massive downturn, not only in the equity markets, but now in the real estate market. People often ask me, what's the first, what's it like, your first 100,000, what's the toughest? And the first 100,000, as Charlie Munger has said, is the toughest. After that, compounding interest, dividends, things like that, they take place and the growth begins to just skyrocket. For those of you that have a larger 401k, you'll notice the first, again, 100,000 was the toughest. And then as you started adding, it really took off. And for me, the last thing, have fun with it. Learning about companies' investment strategies, like learning about a living organism. Things are constantly changing. You're having to keep up. But that's the fun of it. Try to have some fun with it. Again, stick to the basics and, have fun with it, because it should be fun. This is your wealth. This is your generational prosperity. And this is your livelihood. So I hope this was enjoyable for everyone. I hope you were able to learn today. Let me know if you have any questions. Again, I'm going to put some of the links in the description below for some of the investment apps that I use. And I look forward to seeing everyone in the next video. Take care.